So Brent, do you have your daughter napping upstairs behind several closed doors, or?
No. She's at daycare today.
I feel like most of the webinars I've done have been since working remote. I don't remember doing a webinar when we were all in the office.
She's probably too young to be your junior assistant yet. Probably needs to be
Yeah.
able to walk. She should be able to at least walk to become your assistant, right?
Yeah, and she's getting close, so that time may come soon. She's almost walking. And once she starts doing that, you really can't, you can't really stop that. Then she's just on the go all the time.
That is true.
Yeah.
Hey, everyone that's on the line, thanks for joining us today. Feel free to grab some lunch or do a coffee refresh, and we'll get started here in just a couple minutes.
Brent, when my kids started walking, which they did early, I suddenly lost a lot of things like bills back in the day when you used to have to pay them. Yeah. I still to this day don't know where they were at. I miss paying some, and I know they were in a pile, and I'm pretty sure the kids took it and did something with it.
Yeah, they walked away somewhere.
Have you had your vents cleaned before? That seems like the perfect filing place for a toddler.
You know, we never came across some of them. I couldn't even say the dog ate it. I think my kids ate it or something.
So it'll at least be a nice convenient excuse if I lose things.
The dog actually did eat some of the boys' school books. Literally ate every page out of the hardcover book, and they, we had to say that the dog either ate their homework or ate their book.
Yeah. And they didn't believe it.
I would want a parent call or a parent. I'm like, I'm not going and telling my teacher that. There's no way.
I did send the note to the library. I'm like, literally, the dog did eat the book. Please just send me the bill because it's fine.
We're just gonna have to buy the book.
All right, we are noon Central Time here, and I know we do have a lot of content to go through. So again, welcome everyone. I'm Valerie Goldenberg. I'm in business development here at Sikich, but today I'll be your moderator. Our experts, Brent and Karen, will be giving you all the important details on changes for this year's filing season and tips on how to make your audit go as smooth as possible. Before we do get rolling though, let's make sure you're all awake here. We're consistently finally in the 50s and 60s this week, so we're going to throw up a poll about your favorite spring activity. I'm a big fan of hiking. I walk the hills in my neighborhood a lot. Well, when I'm being good, I try to.
You could combine some of these because you could be doing this webinar on your patio with a cocktail right now somewhere.
I'm interested in how many people will check attending webinars. It's quite exciting.
You could have our webinar on your phone and be hiking during it and multitask as well.
That is a really good idea. I've attended quite a few of those that way. So it looks like hiking and biking takes it, followed closely by patio meals and drinks, gardening, spring cleaning even beats out attending webinars. Man, the tough thing, guys. We're gonna have some fun while we weave in all these important content and tips that we have today. Okay. So we are also, before we get started, I'm going to be springing into some information about our firm. Sikich does have a breadth of CPA, technology, and advisory services with a team of over 1,000 top-notch professionals. If we go to our EB slide, as you may be aware, our employee benefit plan audit practice is a pretty big deal too. Today we have Karen Sanchez and Brent DeMay, and I'll let them introduce themselves right here.
Sure. Good afternoon, everybody. Karen Sanchez. I'm the partner in charge of our employee benefits vertical here at Sikich. So that includes most of my time in the audit space. I also oversee our compliance area where we do a lot of plan design, consulting, testing, and then in the welfare space, we also help with doing some of the 5500s as well as ACA reporting, and really all things benefits seem to end up in my department. Brent?
Hello, everyone. My name is Brent DeMay. I am also a partner here in Sikich's Employee Benefit Plan Audit Group. I've been practicing in employee benefit plan audits for about 20 years.
I left out how long I am because I'm not going to talk about age anymore in my life.
Okay, also, here's a more detailed look at the topics they'll cover today. Some SAS 136 in there, the IRS and DOL, of course, and closing out with SOC and governance. And then, okay, last slide from me, I promise. We do welcome questions throughout, so I'll be monitoring the questions box to jump in and clarify things for you with our experts. We have provided the slides in the handout section along with some other key materials. And lastly, you get credit for being here by answering the polling questions throughout and then taking the survey at the very end.
All right, great. Well, I'm going to jump in and cover the first topic, which is SAS 136. It's the new audit standard this year, and it includes some expanded management responsibilities as just one of the things that'll be changing this year. This is really the first time that the uniqueness and the complexities of employee benefit plan audits has really been recognized within the professional standards. Just a little bit of background. The standard was published as final back in 2019. So we've actually had quite a bit of a runway with understanding the standard. And actually there was a 1-year deferral during 2020. So now if you have an audit with an ending date of December 15th, 2021 or later, you will be amongst those adopting the standard. And how does the standard impact your plan? First, it eliminates that limited scope audit. And you may recognize the limited scope audit as you get the certification statement, and that allows auditors to reduce the procedures they perform over investments and investment income. What it also does is it ends up resulting in an allowable scope limitation or a disclaimer of opinion. And that doesn't really describe what auditors are doing throughout the course of the entire audit. What the SAS 136 standard does do is it replaces that limited scope audit concept with a section 103A3C audit, which we will get used to saying, and that will be that'll just be natural soon. But what the 103A3C audit does is it changes the form and the content of the opinion. That's just one of the things that it does, so that there isn't necessarily a disclaimer of an opinion at the end of the audit. There's an actual full opinion that the auditor is providing on that benefit plan audit. One exception that's maybe relatively rare, if you happen to be a sponsor of a 403B plan, there's a different type of disclaimer. If you happen to have assets before 2009, which was before 403B plans were technically subject to ERISA, that particular type of disclaimer would still be considered an allowable disclaimer, but that's just one sort of relatively unique aspect. I did want to point out, we're speaking mostly about limited scope audits, which are now 103A3C audits. If you happen to have traditionally done a full scope audit, which is now called a non-103A3C audit, your opinion is going to change as well. So I put in the graphic here just a little bit of what it's going to look like, just to give you an idea of the fact that the standard will impact you as well. SAS 136 really focuses on that limited scope audit, so that's where we're going to spend most of our time. And most benefit plan audits tend to actually be limited scope audits as well. So on the next slide, and there's a little bit of a lag here. Okay, so I put a graphic, the traditional limited scope audit on the left and the 103A3C audit on the right. As you can see, it's very different. It won't be comparable side by side when you receive your next audit report, so be prepared for that. A lot of clarification, a lot of additional detail relating to the segregation of responsibilities between the auditor and management, and also this change in audit opinion. So this is what I had mentioned a few slides ago, where there's no longer necessarily a disclaimer for 103A3C audits. Now there's going to be a two-part opinion that was developed for benefit plan audits specific to ERISA, where the certified information, so that concept of a certification statement, that still exists to allow auditors to reduce their procedures over investments and investment income. And auditors will still need to opine on the form and content of that certified information. But the second bullet point here specifies anything that's not subject to that certification is subject to a full audit and is opined on directly and expressly by the auditor. And that is new. That's something that hasn't existed in the past. So that's a big change with this standard. Our next slide goes through a couple of those expanded management responsibilities. And if you go through the first couple, the first three, for example, maintaining a current plan instrument, properly administering the plan, determining plan transactions are presented properly, and records are retained for participants with current or future benefits. Well, those items probably feel very familiar because ERISA itself didn't change. From a fiduciary standpoint, these things have actually always been the responsibility of management. This standard largely clarifies and sort of codifies these practices into the professional guidance, as well as directly onto the language on the face of the auditor's report. And that hadn't existed there in the past. In a couple of the other management responsibilities is to provide the auditor with a substantially complete 5500. At Sikich, we have always done this because this has always been a best practice. What this means is an auditor should not be reviewing, for example, just the Schedule H with the financial information against the audited financial statements. The auditor should be reviewing the full 5500 and all the attached schedules as a complete 5500 filing. In this last bullet point, this is, I think, if for the plan sponsors or plan administrators on the program today, I think this is where you'll see the most impact for you personally with this new standard. Management now must acknowledge that it is their responsibility to determine if a 103A3C audit is permissible. And what that includes is assessing and reviewing that certification statement. And management will need to do this assessment each year. So we'll touch on that topic here in a couple slides, but I wanted to also point out that there are some additional auditor responsibilities, and actually most of the standard really is for the auditor. It is an auditing standard, and this list is not exhaustive. There's certainly more that the auditor will be required to do, and that's mostly behind the scenes in our work papers, but I mean, we do have some additional requirements around engagement acceptance and audit risk assessment and planning. And for those of you that are familiar with the audit process, documenting risk assessment and planning is a very extensive part of our work paper documentation. And specifically, this standard wants all that documentation to also include linkage to those relevant plan provisions specific to your plan. And those are things like application of eligibility, vesting, census data, definition of compensation, items that are largely unique to benefit plan audits. Many industries or most industries outside of benefit plan audits do not necessarily have equivalent concepts. And that's really a driving force behind the standard to really anchor an auditor's documentation to a specific understanding of the complexities specific to employee benefit plans. A couple of the other items here are additional communications with those charged with governance. That's a big focus of the standard as well, is to improve that communicative value of the auditor's communication. And that includes the auditor's report, but that also includes any other communications that we have with the plan. And that's going to include things like reportable findings, which you may remember that as called management comments or internal control comments. This standard introduces the term reportable findings that means something quite similar. And also earlier on in the audit engagement, there may be some additional communications relating to significant audit risks that are identified by the auditor. We have additional responsibilities over the supplemental schedules that are attached to the financial statements. And this last bullet point coincides with the previous slide. When management prepares their evaluation of the certification statement, as auditors, we need to obtain that evaluation and review that evaluation. So when plan management is looking at that certification statement, what are you looking for? What are the things that are required to make that certification statement proper to inform us or to engage us as auditors for a 103A3C audit. So the first is that certification statement needs to be issued by a qualifying institution, which is typically a bank, a trust company, or an insurance company. It needs to be signed by an authorized representative of that institution, and either that would be expressly stated on the certification statement, or management would otherwise need to determine that was an authorized individual via inquiry of that custodian. And the certification statement needs to certify both the accuracy and completeness of the investment information. And a couple comments on completeness. Some providers, for example, if you hold mutual funds and an insurance product in your plan, you may actually get 2 certifications over those individual pieces, and you would need to assess those 2 certifications separately. Also, if you happen to have changed custodians during the year, you would need to get certifications from both of those custodians and assess both of them. Yes.
Question, where am I going to find this investment information to answer that last question?
Yeah, well, so that the last question was about how the certification covers measurements. So that's part of the accuracy. And what that is the investments need to be reported in accordance with the financial reporting framework of the plan. So what that means is, are your investments reported at fair value? And if those investments are reported at fair value, are they reported as of the statement date? For example, December 31st, if you have a calendar year end audit. So where can you go to start finding that information about, is this measured properly? How am I going to know that? Well, first, the custodian will provide you an auditor's information package annually, or your audit package. And those are essentially the plan's accounting records. And then oftentimes those custodians will provide an audit guide that goes with it to help you understand what's included in that auditor's information package, and in some of the additional information you'll need to know to apply, to help us apply our audit procedures on that information. They will also provide typically a SOC 1 report that would describe the process of valuing those investments and the controls over those valuations, such as the pricing service. I think that would be the best starting point, and then supplement that understanding as needed with direct discussions with the custodian. The next topic relates to that reportable findings concept that we introduced earlier, that was similar to the management comment or internal control comments. The reportable findings is a term that's introduced within the standard, and in general, reportable findings are matters that are anything more than inconsequential. So anything that is a finding, an observation, a recommendation, that's anything more than inconsequential, is intended to be shared with those charged with governance in written form. And these are a couple examples that are right out of the standard, actually. And these are examples that auditors are charged with evaluating if there's any related reportable findings. It's not exhaustive. These are just a couple of the examples. But if you read through them, they include things like related to plan provisions, timeliness of contributions, census data, compliance testing, SOC reports, and within SOC reports, you have your user controls. Again, similar to what I had mentioned a few slides ago, these are areas that are all very specific and unique to employee benefit plans that auditors are really being charged to spend a little bit more time looking at. And this may result in more written comments or observations, as I'd mentioned in the previous slide, but that doesn't mean that auditors are just looking for more things to find as a result of the standard. Largely, there may have been in the past some comments, some observations that were discussed verbally that now would be under this standard communicated in writing. So that might sort of reconcile what you saw last year versus this year. It doesn't necessarily mean there's anything more or different necessarily than in the prior year. Now, on the theme of that additional communicative value that I'd mentioned, The standard now also requires that we communicate certain matters with those charged with governance relating to significant risks that the plan may encounter. And we put in a couple risks on this slide as examples, and this is more at the plan level or the overall entity level, and it relates to those management override of controls, but also things like changes in service providers or those that are administering the plan overall. And that analysis also goes a little bit deeper and is applied at the individual, more account level as well, such as things like employee and employer contributions is one of our examples here. Notice that we're pointing out that it's really anchored to those relevant plan provisions that we talked about earlier. How do those relevant plan provisions impact the financial statement line items? And also things like plan transfers or mergers. Most plans don't have those transactions likely on an annual basis. So any sort of a non-routine type of transaction tends to introduce a little bit of risk to the process as well. And finally, on the SAS 136 topic, how does this all roll up into the 5500? When you're finished with the audit, you need to attach the audit to the 5500. The thing that really changed with SAS 136 is the type of opinion. And on this slide, this is an example of what you would check for a 103A3C audit. So you would check unmodified, and on line 3B, you would check the first box. If you have a full scope audit or a non-103A3C, line 3B would check box 3 instead. And I think that would take us to our first polling question.
Okay, were you previously familiar with, Were you previously familiar with SAS 136 and its impact on the audit report and management and auditor responsibilities? And this one's just yes or no. Were you previously familiar with SAS 136 and its impact on the audit report and management and auditor responsibilities? Okay. Interesting. So it looks like you are being very informative today, Brent. Looks like a lot of people were not aware.
No, that's good to hear. And in the handouts, there's some additional materials to take away as well.
Hopefully when we talk about this at the end of this year, everyone will be familiar with it after they've gone through the audit process as well. So Brent, thanks for giving us an update on sort of the audit and accounting side of changes for the upcoming year. So I'm going to talk about the regulatory things. What's one of the interesting things about the benefit plan audit space is that we follow all the normal GAAP and GAS rules that Brent just gave us an update on, but the plans are also subject to regulatory oversight by both the Internal Revenue Service and the Department of Labor, and all their rules and regulations also feed into compliance and issues that affect our audit and a lot of the areas that we focus on in the audits as well. So, Brent, if you want to take us to the next slide. Some of these things from an IRS standpoint, you know that there's been a ton of legislation really in the past few years. Secure Act came out pre-COVID with the goal of helping people save more money for retirement. And then we later had CARES Act that helped get money in the hands of participants on a short-term basis to meet some of the needs during the pandemic time. So I'm not going to go take us back all the way in time to cover all these provisions, but what I wanted to do today was highlight some of the things that could be an impact on the 2021 audit. So Secure Act was enacted several years ago. It gave opportunities to amend a number of things within the plan document, again, with the opportunity to have people save more. If you want to go to the next slide, I wanted to highlight the impact that could still be something to take a look at in 2021. We have this new concept called long-term part-time employees. And so what that means is that historically in your plans, you were able to exclude employees that worked less than 1,000 hours a year and not ever need to require them in the plan. The IRS was concerned with the ability for this part of the workforce to be able to save for retirement. And so they enacted this rule that says that if you have employees who worked for you at least 500 hours per year for the last 3 years, you have to offer them eligibility to participate into the plan. Ability for them to make their own contributions into the plan. you can continue to exempt them from employer contributions into the plan, and they will not negatively impact any of your compliance testing as well. If you do choose to provide an employer contribution, their vesting would be based on the 500 hours of service for the year versus the traditional 1,000 hours. Next slide. And so the timing of the effective is the area I wanted to highlight, because while the Secure Act came out and enacted this provision, the requirement to start tracking that 3-year period of time really started in 2021, right in the midst of everything when you had going on with COVID, et cetera. So in 2021, you want to make sure that you are tracking the hours for all your participants well, including that part-time workforce, because that's the start of the 3-year period for knowing if they've met that 3-year window. So 2021, 2022, and 2023 is the 3-year period, because on January 1st, 2024, you're going to need to determine which employees you need to offer eligibility to based on kind of this look back calculation. So it's not there, but you don't want to lose track of what just happened in 2021 as you move forward. If these part-time employees represent a significant portion of your population, they do count in the eligibility count on the 5,500 that triggers the audit. So we're probably going to see some entities that didn't need an audit because they were under 100 and might cross over in future years. Next slide. CARES was the other piece of legislation, if you remember, came out March 2020, came out quickly, and employers had to pivot, at a time when you had a lot of things on your plate, dealing with your workforce changes in response to the pandemic and things shutting down. A lot of these then related to quick access to funds. Some record keepers automatically enacted some of these. Some you had to choose provisions, and some you chose all or none of the provisions. So most of these have sunset on the ability for participants to take money out of the plan. The one thing that we're seeing as it relates to 2021 would be if you allowed suspension of your loan payments during this time. That ended December 31st, 2021. So we should have seen loan payments be reenacted really the beginning of 2021. And we saw some delays with some clients and or record keepers reenacting some of those provisions. So taking a look at your loans, making sure that those were all timely and that everybody caught up with those loan payments. You also could start to see some participants who took some of these larger distributions, they have the opportunity to roll them back into the plan. So you could have seen some increased rollover activity if you did have people take the money out and then now they have the opportunity to put money back in the plan. Next slide. So we talked about all these rules coming out. We can go one more slide. I wanted to touch on, your plan document itself. That's the governing plan. It's the rules of the road for what you're supposed to be following in your plan. Now, some of the things we just talked about in CARES and Secure Act, they haven't been formalized into the language adopted by your plan, so you're kind of doing good faith compliance on those while we're waiting for the IRS to catch up with the language that goes with the rules that they put out, right? There's always additional clarity, guidance, and you don't actually implement those provisions often for a few years in writing from what you put into operation. So every 6 years, the IRS has a process to sort of encapsulate all these different regulatory amendments that they put in over time to roll them up into an updated plan document. 403B's plans just completed this cycle last year. So now we're on to the 401k plans, profit sharing plans, ESOPs, any of the other ones that are using what we refer to as a pre-approved plan. So what the IRS does is it creates, allows document providers to create sort of standard language in a shell. They put all the legal language in what we call a basic plan document, and then they give you kind of that checklist that you're probably used to, where you go through and you choose how you want your plan to operate. You choose your eligibility within certain predefined criteria. It guides you to stay in compliance with the rules because it only allows you certain choices where hopefully you won't run afoul of all these, IRS and Department of Labor regulations that are out there. So through that process, you select your options. As long as you select things that are in the document, the IRS won't question the language that you have in the plan document and the nature of those provisions. Of course, you have to operate under the rules that you laid out, but they won't question the language itself. So it's time to refresh the document. The documents you've been using, if you look at them, they were put out in 2014. So it's time now to to do the updates. They're due by the end of July of this year. So some of you may have done them already, or maybe getting notices from your record keepers and TPAs to be doing the update process. So it is a mandatory requirement to have it done timely. While it's another task you need to do, it's actually also a great opportunity to take a look at the plan. What are the rules? Do they align with your current operations? And is this what you want to do going forward? I would encourage everybody to really take the time to review those in detail. Typically the record keepers map over what you had before and put them in the new area, but there's often changes in the document as well. Some things that maybe were written into the document as a choice, now they might be mandatory in the document, eliminating that choice. Every restatement, again, I'm not going to say how many years I've been doing this for, but every time we've gone through the restatement cycle, we always have somebody who's missed something, and they've always said, I told the record keeper, I just want to keep everything the same. Oftentimes they sign it and don't necessarily read through and understand the nature of what some of those changes were. Some of the changes then can require extra contributions by the employer they weren't anticipating, and it's just kind of a pain, frankly, to clean up those errors. We'll be reviewing these documents as a part of our audit, whether you adopted it in 2021 or 2022. So if you want us to look at it before you've signed it, we'd be glad to do that. We're going to read it anyway. So if we can be part of helping you prevent the error, we'd love, to participate in that rather than telling you after the fact, being the bearer of bad news that there is an error. So we'd be glad to help, with doing the review coinciding with when you're going through that restatement process, if you find that helpful.
Hey, Karen, I do have a question, or we have a question about how to know if their organization has already done the restatement. Could you shed light on that?
Sure, and that's going to be one of the questions we ask on our first planning call, if you've done it yet. If you take a look at your most current plan document, you're going to see if the document still says like 2014, you haven't done it. It should say it's in 2020. Your new IRS letter should be dated in 2020. The date that you adopted that restatement is going to be sometime probably late 2021 or early 2022. Typically, you can ask your leadership team if somebody else, adopted that, or your representative at your record keeper should also be kind of telling you where that's at. Most of them are rolling it out in phases. Some people we've been talking to haven't been notified. Seems like they're rolling it out in blocks, saying, here's your date. You have to have it done by March 24th. Is your date to have yours done, because they're going to move on to the next batch of clients as well. So good question. Next slide. So we talked about the plan restatement. So there's also the plan amendment portion of this. As I mentioned before, those documents are dated in 2020. If we think about when the CARES provisions and Secure came out, document providers had to send all their documents to the IRS several years even before the 2020 date. So those documents, what we're going through all this work, still do not include language with respect to Secure Act and CARES. So you still have sort of these extra amendments that need to be done that aren't yet done. So the date for those right now is the end of 2022. There is proposed guidance out that affects a number of things in the retirement plan space. One of those is trying to get another year to amend those. I think people have document and amendment burnout in our industry right now. So if we can give people a little bit more time to redo the documents yet again, we're trying to get some more time there. But typically that's done by your record keeper, depending on what provisions you adopted. Would require which ones you're going to adopt and the timing of some of that. So there's more amendments on the horizon, is the point there. Next slide. So things are going to go wrong in your plan documents and in your operations while we try to catch all those things. There's so many opportunities for challenges within the plan. So the IRS does have various programs available to correct things. Some of them require you sending the plan to the IRS for correction. Other things you can fix on your own and just document your analysis, your findings, and how you did that, so that if it's ever questioned, you would have that documentation. Similar to your health, that early detection is great. Same thing holds true here, that if we find errors early, they're so much easier to fix. And so that's some of the reasons when we're going through the audit process, we really want to try to catch things as early as possible. All those annoying questions we ask you, it's to help you kind of identify if things might need to be addressed sooner. So if things are found early, and there's certain, as with everything with the IRS, there's a whole set of rules, right? But if we meet certain conditions, they can follow these correction procedures and not have to go to the IRS and not pay the user fee associated with that. which is obviously, if you don't have to write a check, that's always a good day. The IRS did refresh their rules for the self-correction program last year. So we had some nice features within that. So previously, the self-correction program allowed for you to fix things 2 years after the error occurred. Now you have up to 3 years for the error occurring. So a little bit more runway. And when you think about, it sounds like a long time, but if 2021, we finished that, now we're already in 2022. If we identify something in the audit late in 2022, before you know it, you're in 2023. So that 2-year period really does go by pretty quickly sometimes. There were certain rules for if you overpaid individuals, you didn't have to take action if amounts were over 100. Now you get up to $250 to not be required to fix those. One of the most common errors that we find in the audits is the amount of contributions withheld from participants' checks not being in alignment with their election. That can happen because a participant logs on to the record keeper website and says, I want to do 5%, and it was either entered incorrectly or not timely into that employee's paycheck. It can happen because your plan has, or it was not set on the right type of compensation is another very common one. If the plan says, if I elected 5%, it needs to be on total compensation, and the payroll system was set up to exclude overtime or bonuses or commissions or something that doesn't match the plan document, that's another error that would need to be corrected. You could also have errors because your plan says auto enrollment and you didn't timely auto enroll, participants that were eligible. So lots of opportunities for things to go wrong in that area. And so what the Irs Correction Program says is that certainly any employer money that that participant was entitled to should receive that full amount so that they're not shorted. But the concept under any Irs Correction Program is make the participant whole as if the error didn't occur. So if they didn't put the money into the plan that they elected to do, we need to make them whole. So certainly any employer money would need to be funded to the plan. Applicable earnings should be funded to the plan for what they lost in the market. The part that varies on how you correct it is on the deferral piece. We can't go back in time and take money out of the participant's paycheck for a period of time and go back and do that once they've already been paid necessarily. So in certain instances, the sort of the default correction is that the employer would deposit half of the money the employee put in, sort of meet them halfway. There are times, certain circumstances where you can do 25% of that amount. The best case is when you don't have to put any contribution in for the employee deferral amount. And one of the criteria for that is in the auto enrollment program. When you have that, the program said that if it's corrected within 9.5 months after the plan year, you don't owe any of that employee money. Well, that provision was scheduled to sunset, and so they expanded that provision. So if you auto enroll, you have an oops. As long as you catch it then within that 9.5 months, which happens to coincide with the audit period. So hopefully, if it's something that's been missed, we might identify that, and you'd still have the opportunity to make those corrections and not owe the employee share as well. Some of the correction items don't require money to be put in the plan. It's that you had a provision that you were an allowable provision that was enacted, but you didn't actually put it in the plan document. So for example, if you allowed loans, but you forgot to put a loan provision in, you can retroactively amend the plan for certain things without IRS approval. And the amendments expanded the opportunity to do that for areas where maybe it didn't affect all the participants, just a subset of that. So they gave us a little bit more wiggle room where we don't have to go to the IRS and pay that user fee. Next slide, Brent.
Hey, Karen, we do have a question kind of relating to that previous slide as well from a client. If Sikich is our auditor, should we have Sikich review our plan restatement prior to finalization?
I would always recommend it. I always prefer to be helpful in your solution to provide guidance and recommendations on that versus me telling you a year later that there was an error. Not all those errors can be fixed by self-correction. Now you start to get in an area where you might have to consult legal counsel as to whether or not you can self-correct that error, or if you have to apply to the IRS and pay the user fee associated with some of those things. So I would definitely recommend it. Like I said, we're gonna read it anyway a year from now. So if you're in the process of working on it, we'd be glad to take a look at that along with you to support you in that function. So I give a very brief overview of what the IRS has been up to. So the Department of Labor has had some guidance issued as well that affects benefit plans. You know, cybersecurity could be in its whole own session, so we're not going to do a deep dive here, but focusing on how it affects the plan participants as well. I think many times plan sponsors, or certainly you're focused on your own internal network, how you manage your email, your own network, database, things like that, recognizing that your plan also is affected by the record keeper that you've chosen and the communications that go between you and the record keeper. And similarly, many of you may have payroll, you know, on the web in these days, and your communications there, and your payroll services and controls over some of the cybersecurity things. So keeping in touch with your participants to remind them about the plan assets. There's a lot of money in retirement plan assets out there. And so certainly the cybersecurity criminals of the world know that if they can get a hold of retirement plan accounts, there's money there that maybe participants don't download their statements. I mean, there are a lot of people that don't log in, don't look at their accounts, and there's really been no activity. And so if they are able to get a login and take a distribution out of the plan, particularly for terminated participants who are still in the plan that really aren't looking at that, and it's sort of a dormant account, logins not used, they can go in and reset logins, things like that. So making sure you're educating your participants, encouraging them to look at their statements, incorporating the plan affected things in your training as well, and understanding what your other outside service providers are doing with respect to cybersecurity, and how does that interplay with your own cybersecurity insurance, as well as, you know, the training that you're doing with respect to those plans. Next slide. So Department of Labor is concerned about this area. There's been several court cases that came out from several years ago, but as the legal system takes time, some of those have just come to fruition, and some of those related to participant account balances being just money stolen, right, distributed in error. And whose responsibility is it? Is it the record keeper, or is it the plan sponsor, or is it the participant? I don't know that those things have necessarily been determined. It's very facts and circumstance based. But it is an issue that's out there. When those things happen, whose responsibility is it? The record keepers put their rules out, they put their user controls out there that Brent will talk about in the SOC area. So certainly nobody wants to be paying those loss claims. And so where is the liability going to be ending at? So certainly on your side, you want to have some best practices for your oversight over your plan in this area. Department of Labor issued 3 forms of guidance last year to help provide some insights as to what you should do when you hire a service provider, your own internal best practices, and then some security tips for plan participants. And in rare Department of Labor form, they actually already started their audits of this. Typically legislation comes out and then it's several years later. Well, they actually last year already started doing audits, investigation of plan sponsors to see how they were complying with some of these areas. So it's definitely an area that the Department of Labor is concerned with. Brent, can you go a couple more slides?
We're going to launch our second polling question.
Okay.
Does your organization have cybersecurity policies and procedures in place over the plan's sensitive data? Does your organization have cybersecurity policies and procedures in place over the plan's sensitive data?
This is an area that Sikich has a strong cybersecurity team on as well. So while I'm not going to pretend I'm the expert at it, it's one of our phone a friend areas where we bring in, you know, partners in that area to help us understand inquiries in this area.
Looks like a lot of our clients and friends of the firm do have some pretty good cybersecurity practices in place, so that's great to hear. And if you're not sure and you have additional questions, you can always reach out to Karen, Brent, or myself.
Thanks, Val. So the other piece of the Department of Labor update I wanted to touch on was the missing participants. So in this age of great resignation, there's a lot of turnover. Participants don't always move their money out of the plan, so you end up with those terminated dormant account balances that I mentioned. Plan sponsors have to continue to send notices out. You know, some of the costs associated with your record keeper is a per participant fee. It affects a number of the pricing on your plan, things like that. And frankly, you know, you just don't necessarily want to hold on to people's money for 20 years or so and then still affect understand that they're going to know where their account balances are. So it's a good best practice to continue to try to keep current information on people and show them how opportunities of how they can roll money out of the plan. The Department of Labor refreshed their rules on how to deal with missing participants, other sources where you can transfer money to IRAs, how to find people, things of that nature. So it's another part of the administration to take a look at, again, trying to not have those dormant account balances in the plan and make sure they're getting to the participants and not staying in your plan longer than necessary. Next slide. So on the compliance side, most of you have either finished your compliance testing or in the midst of doing that. So we want to just highlight a couple things to be on the lookout for in that process. One of them is leased employees. Certainly those would be if you have workers, worksite people that are performing services on your premises or in your operations, but they're not getting a W-2 from your organization, you're using a staffing company. Typically those are short term, they come and go in a month and you might do a permanent hire. If you're keeping them longer than 12 months, you want to make sure they're excluded in your plan document because there's a provision that starts to make them eligible, which is frankly an administrative nightmare. But if you have a large portion of your workforce that has leased employees, it could affect some things on your coverage testing too. So if that's part of your workforce, something to be on the lookout for. Similarly, if you have other excluded employees from your plan, again, that plan document allowed you to exclude certain categories of employees, but you need to make sure that that is incorporated into your testing process. So oftentimes that census file that you provide to the record keeper, you want to make sure that that was complete. You want to make sure you've communicated how you're handling different parts of the workforce so that they can do that compliance testing properly. One of the first things we ask you for is that census file. Often and trying to understand who's in and not in the plan. So those can affect a lot of the ways that compliance testing was performed. Next slide. Also in that questionnaire, it typically asks you about related entities. So if there is enough common ownership or common operating criteria between different legal entities, you may have to test them together. So you want to make sure that you know what other organizations might have to be considered under the plan, make sure they're included in the plan document if they're participating in your plan, or make sure that somebody's looking at everything holistically for that group of organizations. It has been a time of a lot of M&A activity, buying and selling businesses. So there is a transition period where you may not have to include them, but you want to make sure that that has been looked at and determined if they need to be included or what the game plan is to make sure that they're going to meet the eligibility requirements at the end of that transition period. Sometimes in that process, you end up with plans at different service providers. So making sure you understand who's going to be designated to bring everybody together for that testing. Next slide. We also saw, depending on the industry you're in, decreases in workforce. It could be because of a sale of a division. It could also just be downsizing because of the challenges of operations. If you had approximately more than 20% of your workforce impacted, it's deemed to be a partial plan termination. And in that case, you might have to 100% vest some of those people. Last year, the IRS gave us some transition guidance in that area to help. But again, something to look for as you're taking a look at what happened in your workforce in 2021 or even into 2022. This isn't a year specific thing. It looks at trends. And maybe this didn't happen in 2021. Maybe it started in 2020 and is continuing into 2022. So it's like I said, a series of events type of an issue, not a plan year specific one. Next slide.
Hey, Karen, if someone already completed their compliance questionnaire but did not include all employees in their workforce, how would they go about correcting that?
At first, see how many people were impacted, and certainly talk to your record keeper and see, it's going to depend on your plan document provisions as well as, if you're a safe harbor plan, you're just deemed to pass the testing, it may not impact anything. But it just depends on what the nature of them are. What if some of them were part-time employees and we just said you needed to be tracking them for 2021? You may be missing that component of a compliance criteria coming for 2024. So probably generally talking to your record keeper, but it's one of the reasons why we like to see the census file, have everybody in there tying back to your total population so that we know that everybody can be considered properly. But usually a record keeper can kind of help navigate that. That's one of those depends kind of answers. Timeliness and contributions is a big issue. Brent mentioned this could potentially be a reportable finding included later in the letter. we had all this transition of personnel in many key roles as it relates to the plan. So during those times when there was nobody sort of sitting in that chair responsible for remitting contributions, did everything happen that was supposed to happen? One of the first things you want to do is one of the first things we do as well, is we want to make sure everything you withheld from payroll went into the trust subject to timing. If those two don't match, we need to identify why they're missing. And oftentimes it's missing contributions, adjustments that happen to pay, things like that. Secondly, if the money did get into the plan, did it go in on time? Again, 2021 was not an easy year for finance and human resources, certainly. And so we are seeing just a lot more errors in this area than we typically would. So identifying those early, because sometimes they do take time to correct, so that we're all ready to file that, and we just need to kind of get those cleaned up at the front end of the audit process, makes it go a lot more smoothly as well. Next slide. So take a look at what amendments you adopted during the year. Some of these affected compliance testing. Maybe you were safe harbor before and now you're not, and you need to run your testing. A reminder, anybody with self-employment income, this often gets messed up. You need to make sure that that's the number off of the K-1s, not draws or guaranteed payments. So typically you don't know that number until the tax return's done. So often we see that testing done now and the tax return's not done for several months. So there might be some errors in the compensation that you're using there. I think that's what I've got on my update. I know I got excited and took a lot of time on that, so I'll let Brent catch up on some other audit strategies. Another folder.
Yeah, well, we just wanted to put together and leave behind with everyone some of the strategies for a more efficient audit process. We would always recommend putting together an audit planning call, include your audit engagement team, as well as the key members of plan administration to get together and be ready to discuss any sort of questions or concerns you might have for the year. For example, SAS 136, like we discussed, assessment of the certification statements that we discussed earlier, as well as anything like the communications with the DOL, IRS. Have you consulted with counsel? Any of the late or missed contributions that Karen had just mentioned? Did you experience any of that during the year? It's always easier to let your auditor know up front that that's something that happened, and your auditor can help you remediate that as well. And also set your timing expectations in terms of what your target filing date is and what some key milestones might be, both on the management and the auditor delivery side. And also identify when your auditor's information package might become available. If you don't happen to have your auditor's information package yet, it may be worth reaching out to see if that's available. We've noticed that a lot of information has become available sooner this year than it historically had in the past. And we'd always recommend you have a central person sort of go through all the auditor inquiries and handle that. A couple of the other things to keep in mind for the planning call. I mean, what kind of changes have you had in the plan? New people involved in the plan, service providers changing, even if that change hasn't happened yet. A change that's upcoming could be a subsequent event disclosure. New payroll codes. This is something we've seen quite a bit in the last year or two. If there's been any new payroll codes set up, bring those up and notify the auditors what those new codes were, just to make sure those codes were set up properly, and then follow the plan's definition of compensation, along with any sort of transactions like merger transactions or plan terminations. And Karen had touched on the restatement of plan documents. If you haven't got that restatement yet and you happen to have one of the pre-approved plans, you may want to look into that or contact your document sponsor to get an idea as to when that will be complete. Then, of course, on the audit side, we're going through a lot of the detailed participant testing. It's always a good idea. Get your census file, get your payroll reporting, make sure they reconcile to each other. And then from the audit perspective, we'll select samples and provide some information requests with those specific to those individual participants, and be sure to have that information ready timely based on that timetable that we ideally will put together. Now, if there are any information requests that aren't readily available, be sure to discuss with your auditor if you have alternate information that may be easier and suffice just the same. We don't want you to spend too much time when there's another option that would work for you. Things like minutes as well. If you've received any management comments or internal control comments, which are now called reportable findings, if you've had any of those in the past, what have you done to address those controls that you've put into place to make sure those don't repeat, and obtain and review that your SOC report for each of your service providers? And I know real quick, next, that'll lead us to the next polling question.
Our polling question is, do you review your SOC report? Do you review your SOC report? All right. Pop the answers up in here. Feel free to be as honest. What is a SOC report? Love that. No, but we will this year. Great.
All right, well, it looks like we had, was it about half that review and document? There's quite a few that review and don't formally document. We hope that we can encourage you to do so. We do have our next section, and we'll cover briefly relating to understanding your SOC report. And this is something that plan sponsors really have that fiduciary duty to oversee. These are your outsourced service providers. They are processing a majority, if not all, of the transactions held on behalf of the plan. So it's incredibly important that plan sponsors are obtaining those SOC reports and reviewing those SOC reports for your record keeper and your payroll provider at a minimum. And then, of course, documenting those reviews formally, very important. We have a checklist that we provide to our clients to help them with that. You could use a memo. In our materials, I think we have an article that goes through some of the key things to look at in addition to these slides. And of course, discuss that review in your minutes, discuss it with those charged with governance and the oversight committee, and make sure that all questions are answered and the review of the SOC report is understood. And I went through and put together some sort of bullet point, sort of punch list items for you to consider when you're reviewing your SOC report. I won't go through all of them, but just make sure that your SOC report covers your full plan year, or you get a gap letter or bridge letter for any portion of the year that's not covered, and that there's a clean opinion. Otherwise, if there is any qualifications to that opinion, you understand what those are and if those impact the plan as well. And if the firm that did the SOC audit, is that a firm that you're familiar with, that has a SOC practice that is a reputable SOC practice. Make sure you're covering all the services that your plan uses with the record keeper. Sometimes there's sub-service organizations. For example, maybe the IT environment is carved out of the SOC report, and that would be relevant, and you would need to get that second SOC report to make it a complete evaluation. But one of the most important areas to review are the complementary user entity controls. You might remember, several slides ago when I was talking about reportable findings, in some of the things that are listed in the actual standard of SAS 136 of things that auditors should look at are things like, is the SOC report being reviewed, and are the user controls in place? And that's what we're repeating here. Very important to look at those user controls. That SOC report contemplates that plan sponsors have those controls in place so that the plan can rely on that SOC report. So really spend some time and make sure that you have those user controls in place and that your control is operating effectively. And just a couple key takeaways. Make sure that you're getting the SOC reports, you're performing a review, you're documenting that review, you're getting those user controls and understanding of those user controls, you're making sure those controls are in place and performing properly, and then of course consult with your auditor if you have any questions on how to best document for your purposes of oversight as well as a smooth audit process.
Thanks, and go ahead and go to the next slide, Brent. So the last section is just going to be on how do we tie this all together, kind of from your governance, and again, the theme here today being documenting things. So Typically, if you designate certain people with the responsibility of the plan via a retirement plan committee is a great way to make sure it gets done. Setting a calendar for regular recurring meetings of the plan is another way to make sure it gets done. And then just really documenting the decisions that were made by that group. Typically, we see the committees made up of somebody with experience in both the benefit side, accounting, legal, and/or finance. It's typically senior members of management. Typically, your investment advisor participates and/or even quarterbacks that process. Don't make it be too large, or you're never going to get all the people together in order to execute and have those meetings. Make sure that members understand their roles and duties. I'm a big advocate of schedule it, and it'll happen, it'll get done. Assign somebody who's responsible for taking notes in that meeting and document them. After I do our quarterly retirement plan committee, I immediately write the notes down. If you're like me, you don't want to remember what happened a day earlier, a week earlier, just kind of write it down, whatever happened. And so it's just available. This is one of the main items on the Department of Labor audit request list. They want to see the meeting minutes. They want to understand what decisions were made. On behalf of the committee, they want to see evidence that you were overseeing and monitoring your service providers with respect to that area. If somebody different is sitting in your chair, it gives you a roadmap for what was discussed. Many times the investment advisor will do the investment performance, but what we see missing is what review was done by the committee, what actions were taken in response to that sort of quarterly investment review booklet. What did you do with respect to plan provisions and edits and amendments in that area? So just writing down kind of what you talked about during that process. Next slide. Don't forget to review your service provider in that process. We listed some things here to take a look at. We've talked about a lot of these today, taking a look at fees, cybersecurity policies, things of that nature are great things to include. You want to go to the next slide? And then you can go one more slide. And really, this is kind of a sample agenda that you could have for each of your quarterly meetings, approving the minutes, talk about what's happening in the industry, but whether it be legislation, guidance, court cases, take a look at the market, your performance, how is the plan operating with respect to participant stats, things of that nature. And certainly you can include a number of other things like your SOC review annually, your audit report annually, things of that nature. I think that takes us to Val to wrap us up. I think you're muted, Val. Had to happen once on the call.
Before we close out and launch our survey, we wanted to make you aware of our Employer Resource Center.
I think she froze there, at least on my end anyway. So we've got a link here to Employer Resource Center where we
check that. We will include that link along with your handouts, and make sure you bookmark it back there for latest scheduling. Sorry, go ahead. If you didn't get to address your question today, Karen or Brent will be in touch with an answer. Thank you so much for joining us, and remember to stay on to take the post-webinar survey so you can get your CPE, RCH, and HRCI credits. Thanks so much, Karen and Brent.
Thanks, everybody.
Thank you, everyone.